Hello, my name is Maverick Rourke. I am COO at Travis Watkins Tax. And do you mind introducing yourself for us?
Yeah, you bet. Travis Watkins, principal and senior attorney at Travis Watkins Tax. We help troubled taxpayers is kind of our niche, help them file old returns, negotiate IRS deals, offers and compromise, file returns, and really pretty much a full service accounting department. And let me give you a quick background here too on kind of how this is all relevant. Back in 2020, when the pandemic hit, we pivoted a little bit some of our practice to the Paycheck Protection Program. The IRS was closed anyway, and at the same time as PPP was coming out, and we were helping folks with that, this new thing called the Employee Retention Tax Credit came out, and we helped a few folks with that too. But now things have changed quite a bit with the ERTC, as I call it, and that's what we're talking about today.
Yeah, thank you so much for bringing that up. I've received a lot of questions from our clients, just wondering what even is it?
Yeah, a lot of people don't know. It's kind of been a little secret there, or if you did know, maybe you didn't think it applied to you because there's been a bunch of changes with the rules related to this thing. But in a nutshell, the Employee Retention Tax Credit is a reward to employers who have employees, I might add, that kept those employees at a really tough time in America during the pandemic and beyond, 2020 and 2021. And really what it is, if you qualify for this, and we can talk about the qualifications here because they've changed as well, but if you qualify, every quarter that qualifies, you are entitled to up to 70% of that employee's pay, up to a maximum of $26,000 per employee. So we're seeing some big checks come through for clients on this. It can be a very good thing for you. And I guess the best part of this is it really is free, no strings attached kind of reward for keeping those employees during the pandemic. It's not a taxable thing. You don't have to spend it on certain things like more payroll, rent, utilities, those kinds of things that you had to pay or had to use that money for on PPP. It's just really a deal that you can take advantage of until the money runs out, so to speak. There's $400 billion worth of credits out there, and hasn't yet started going too fast. So that's what we're talking about.
Now, why isn't this all over the news, and why doesn't everybody know about this? I mean, there's I think I was reading the other day that about 95% of the fund is still left unspoken for.
Yeah, I would have to say it's just because people don't know, businesses don't know, or they're under an old impression of what it used to be. And here's the big hang up. When PPP came out and ERTC came out at the same time, there were some rules saying you can't take the ERTC if you've taken PPP money. So they became a mutually exclusive, I guess, two types, one or the other. You could take PPP or you could take ERTC, but you could not take both of them. That has changed. And so have some of the rules, some of the other rules that relate to the ERTC. And we'll talk about a few of those here in a minute, but it's become more inclusive, I guess, so to speak, because not a whole lot of business owners were taking advantage of this thing. So the Biden administration opened up the gates a little bit on this, and we've got to think that as more and more business owners hear about other business owners getting big checks like this, it's going to start another type of frenzy, kind of like the PPP was.
So how can you qualify for this program?
Yeah, so
Or at
there's
least now, sorry.
right. Yeah, well, we can talk about how it used to be and how it is now too. It used to be that you had to show either you had a full or partial shutdown due to COVID, and that had to be documented by some type of governmental order or rule. You also, or instead of that requirement, you had to show that you had a substantial gross revenue loss. And back in 2020, that meant that you had to show that 50% or more of your gross revenue had taken a hit. And as compared to that quarter in 2020, as compared to that same quarter in 2019. That requirement has changed a little bit. For 2021, the law now is that you only have to show a 20% reduction in your gross receipts. The third one that you could fit under would be what they call a disruption in your supply chain. And that's the biggest, newest change in the requirements. Because what does that mean? I mean, we've all experienced some type of disruption in supply chains, and that doesn't mean just, construction outfits that have had a disruption in getting materials and supplies, for instance. It means we've even seen law offices, law firms that since the courthouse was shut down, they couldn't get, as many customers, as many clients. Everything's kind of up for grabs in that kind of catch-all deal now, and it's letting more and more people into the program. The cool thing as it relates to these requirements is you can kind of pick and choose which one of those three that you want to use on a certain quarter. So for instance, if you were shut down some in the second quarter of 2020, but you open back up in the fourth quarter of 2020, you can still look at the quarter four of 2020 in that scenario under these other possibilities, such as reduction in gross revenue of 50% or 20% as it relates to 2021. But the big change, the big requirement that I think is going to let more and more people in, and I think the reason that the Biden administration even opened it like this was because supply chain deals, disruptions, that's going to let more business owners qualify and start taking more and more of this limited pot.
That's huge. That's
Yeah,
a big change.
It is.
So I actually had a gentleman call the other day, and he was stating that his business is shut down now, but it was open during the pandemic. Can he still qualify for this?
Yeah. There's no requirement built in there that you are now still open. And a lot of businesses, let's face it, they had to shutter because of all these problems. But there's no requirement that you still be open in order to get the benefits. You just had to fit within those confines that I just talked about. You had to have something to show for 2021 in order to qualify.
So what if you got PPP during that time as well?
Yeah, like we talked about, I mean, at the get-go of this thing, it was mutually exclusive. You could take PPP, or you could take this tax credit. And along the way in this legislation, as it's changed, now they've done away with the PPP restrictions. So in other words, if you've received PPP in the past, rounds 1 and or 2 of PPP, it's not going to prohibit you now from being able to take the ERTC. And I think a lot of people didn't realize it. To the extent that they even knew that this program existed, they may have looked at it back in 2021 and thought, well, I got PPP, so I'm no longer, or was never able to get this type of benefit. So they just kind of swept it away and forgot about it.
Gotcha. So what if the only employees were the owner and let's say the owner's wife or husband or kids or cousin, do they still get to go and
Yeah,
qualify?
great point. And there's some confusion out there too, because if you'll remember back in I think it was back in 2020, it started off, you had to have employees to get PPP. You couldn't do independent contractors. You really, self-employeds were kind of at a disadvantage in there if they didn't have additional employees, and they changed that rule to allow more people, to allow independent contractors to also take the PPP. To be clear, you do have to have employees for the ERTC to work. So no, just, sole proprietor type stuff. That's also backed up by another rule by the relating to the ERC. They won't let you take the credit. Owners can't take it, and family members that related to the owner cannot take it. So those will be subtracted out of your calculation here. And let me talk about that calculation here as well. Once you've kind of cleared that first hurdle that yes, you qualify because of one of those three reasons: you're shut down, partial or full, you had a substantial reduction in your gross revenues, or you had a supply chain disruption. Once you've met one of those three for that quarter, now you move on to the second part of this thing and you figure out which employees, their non-owners, get to be thrown into the calculation for figuring out how much you get. And once you do that, then you're up to, you can get up to 70% of what you paid out for that quarter. And you can get multiple quarters.
Okay. So let's say that a business qualifies. What type of information should they gather and to get going on this?
Yeah, we're proud to say, since we're offering this thing, that we've got it streamlined down to about a 15-minute process. Like 15 minutes or more or less could get you a pretty big check on this deal. What you're going to need to show, obviously, is to fit into one of those three categories earlier. You're going to need to have some backup. You're going to need to also show that 2019, you're going to need to have your numbers by quarter of what your gross revenues were there. You're also going to need to have, profit and loss is usually the main thing there to show comparison of quarters, whether you lost some in 2020 versus 2019, or quarters in 2021 versus those same quarters in 2019. So usually profit and loss is what you're looking for. You're also going to need to have 941s, what you paid those employees for each one of those quarters, so you can do the calculation of how much you're going to be entitled to. And payroll employee-wise summaries would also help in that process, so you can see exactly how much each one of those employees made, up to a cap of $26,000. But other than that, those would certainly streamline our discussion with new clients about this. But we can, if you don't have those things, we can help you get the documentation, or you could kick it old school even and get your bank statements and add those up by quarter and compare them.
Yeah, and let's kind of talk about that a quick second. But
Yeah.
tell us about like kind of the risk if they try to do it themselves versus professional doing it that has been doing it.
Yeah, right. Well, I mean, the fact that you could do it yourself, I would say, could you, cut on yourself instead of going to a surgeon? I guess you probably could, through a lot of pain if you have those thresholds. The real question is, should you do it yourself? And that's only something that you can answer. But I can say that, if you have someone who does this all the time, like we have been doing, we can certainly bend the learning curve substantially and make this a much easier process, because we've seen all the pitfalls. Let me give you a kind of an example. I mean, back in 2020 and 2021, up until the fourth quarter of 2021, the IRS was using a form 7720, and it changed a bunch of times. And if you weren't using the right form, you may have submitted on the right form, and then months later, when they took a look at this thing, you weren't using the right form anymore. They'll say they would kick it back and make you start over. Essentially, we've been through all those things. We know how to do all the, essentially the appeals for it and resubmissions for it. Your rank and file tax preparer, maybe even your CPA may have done a few of these, but most of them we're seeing, they're just like the rest of us. They hadn't heard of this thing, or they looked at it back under the old rules and said, no, sorry, clients, you're out. You're not going to be able to get this. So there's going to be a learning curve for your CPA or folks that professionals that don't do this every single day.
I've heard that quite a bit just this week, where their CPA told them that they don't qualify for it, and explaining to them that it's kind of opened up to a lot of businesses now. So
yeah, I mean, it's not your fault, these things changed, and there wasn't a whole lot of publicity about it. It's still a limited fund. There's $400 billion out there to get, and honestly, if you compare that to like the first round of PPP, which was $500 billion, that $500 billion got scooped up in 120 days. I don't think the demand, it certainly hasn't been that high yet, but it's changing as more and more people hear about it. And you're going to want to be able to submit this correctly one time and let the IRS do its thing. It's going to take a little bit of time, but you don't want to have a bunch of starts and restarts and double backs. And it is a finite fund, and it's going to run out at some point.
So this is huge for a lot of businesses. This is going to open up and give them free money. Ultimately, how do they get started, and how do they reach us?
Yeah, go to our website. We've got a tab there at traviswatkins.com. Under the Employee Retention Credit tab, there's an application there that will streamline the process for our discussion, which would be about a 15 or 30-minute consult, free of charge, by the way, so that we can start rolling the ball on how much you could be entitled to. There's going to be numbers here, I would assume, on whatever platforms we're running this thing, that also will get you hooked in immediately to one of our ERTC experts.
Perfect. Hey, Travis, thanks for talking to me today. This helps out a lot.
Yeah. Stay tuned on this medium, because we're going to be breaking this thing down, and we want the most people to take advantage of this thing. There's really no reason that you wouldn't want to do this deal if you're a business owner, or at least have it looked at again if necessary, to make sure that you don't qualify for some amount of aid here. I often say, take the credit. You won't regret it. When the IRS, the federal government, is handing out a finite amount of money, especially to reward you for keeping your employees paid during tough times, you take that.